Dubai, a city that builds the impossible, a global hub for business, tourism, and luxury. In recent years, its real estate market has become a phenomenon, attracting headlines and investors from every corner of the globe. We've seen record-breaking transactions, unbelievable rental yields, and policies that make it one of the most investor-friendly places on earth. But with so much noise, a critical question remains. Is Dubai property in 2025 just a hype story fueled by speculation, or is it a truly smart, sustainable investment for your future? In this dive, we're going beyond the headlines. We will unpack everything you need to know, the real numbers behind the transactions, how to calculate your true rental returns, where the next property hotspots are, and the crucial due diligence steps you must take before you invest a single dollar. This isn't just about buying property. This is about securing a smart asset for tomorrow. Let's get started. In the first half of 2025, Dubai's real estate sector hit a staggering 431 billion dirhams in transaction value. That's nearly a 25% jump compared to the same period in 2024. But let's break that down. It's not just about the total value. The number of transactions themselves rose by about 26%, crossing 125,000 deals. That's a clear sign of broad-based demand and deep market confidence. Now let's dig deeper. Where is this activity coming from? The market is split into two key segments: the off-plan market, where you buy directly from a developer before completion, and the secondary market for ready properties. In H1 2025, the off-plan market saw a surge, accounting for nearly 60% of total sales value. This indicates strong investor belief in Dubai's future growth, as they are willing to invest in projects years away from delivery. Let's put this growth in global perspective. Cities like London, New York, and Hong Kong are mature, stable markets. Their growth is typically slow and steady, usually just 2–4% annually. Dubai is in a high-growth phase, outpacing them significantly. Even more exciting, over 59,000 new investors entered the Dubai market in just 6 months, adding more than 157 billion dirhams worth of transactions. And we're seeing a diversification of nationalities. While investors from India, the UK, and Russia remain strong, there's a significant uptick from Germany, France, and Canada. That's not just growth, that's new money, new trust, and new global confidence in Dubai's property ecosystem. One of the biggest reasons investors love Dubai: rental yields. While cities like Singapore or London offer average yields of 2–4%, Dubai averages between 6–9%, with some communities pushing double digits. Take affordable, high-demand areas like International City or Discovery Gardens. These have consistently delivered gross yields of 9–11%. They are prime hotspots for investors who prioritize immediate and strong rental income. Luxury neighborhoods like downtown or Palm Jumeirah typically offer around 5–7%. But remember, luxury properties often come with strong capital appreciation, meaning your asset value itself grows over time. But savvy investors know it's not about the gross yield. It's about the net yield, the profit left after all expenses. So what are these expenses? The main one is service charges. These are annual fees paid to the building management for maintenance, security, and amenities. They can range from 10 dirhams per square foot in affordable buildings to over 30 dirhams in premium ones. Let's do a quick calculation. A 1 million dirhams apartment renting for 80,000 dirhams a year has a gross yield of 8%. If its annual service charges are 15,000 dirhams, your net rental income is 65,000 dirhams. Your net yield is now 6.5%. It's a crucial difference. Another factor is the rise of short-term rentals. Platforms like Airbnb can offer significantly higher yields, sometimes 12–15% in prime tourist spots like Dubai Marina or downtown, especially during peak season. However, this requires more active management and furnishing costs. For the passive investor, a long-term rental provides stable, predictable income. Rental income is one side of the story. The other, arguably more powerful side, is capital appreciation. In 2025, areas like DAMAC Hills, Dubai Creek Harbour, Business Bay, and MBR City saw property values rise between 10% to 21% year-on-year. For example, villas at DAMAC Hills jumped 20.7% in value in just 1 year. But it's not only luxury communities. Mid-range and affordable hubs like JVC, Dubai Silicon Oasis, and Arjun are delivering strong growth too. These areas combine high rental yields with steady price appreciation, a perfect formula for a balanced portfolio. So how do you find the next hotspot? Look for catalysts for growth. One, infrastructure development. Is a new metro line planned? The extension of the Blue Line, for instance, is set to boost values in communities along its route like Dubai Creek Harbour and Silicon Oasis. 2. Master developer vision. Look at projects by master developers like Emaar, Nakheel, or Meraz. Their communities, like Dubai Hills Estate or Blue Waters, are designed as self-sufficient ecosystems with schools, parks, and retail, which drives long-term value. 3. The ripple effect. When prime areas like downtown become too expensive, demand ripples out to adjacent communities. Business Bay benefited from downtown's growth, and now areas like JVC are benefiting from the growth in Jumeirah Village Triangle and Dubai Sports City. Following this ripple can lead you to undervalued areas with high growth potential. Dubai doesn't just attract investors with returns, it gives them confidence through a robust ecosystem of clear policies and protections. Here, what makes Dubai unique? The tax advantage: zero property tax, zero capital gains tax, zero rental income tax for individuals. This is a game changer. Investors keep significantly more of their profits. Transparency and regulations. The Dubai Land Department, DLD, and its regulatory arm, RERA, govern the market. Escrow accounts are mandatory for off-plan projects, meaning your money is held by a neutral third-party bank and only released to the developer upon meeting construction milestones. This protects you from project failure. Ease for foreigners. Freehold ownership is available in hundreds of prime areas, giving you full ownership rights. There are no restrictions on repatriating your profits. And long-term golden visas, available for property investments of 2 million dirham or more, grant you and your family residency, solidifying your connection to the city. Let's talk more about the golden visa. It's a 10-year renewable visa that isn't tied to an employer. It gives you flexibility, security, and a true sense of home. It has been a major driver for high net worth individuals to not just invest, but to relocate their families and businesses to Dubai. Furthermore, Dubai's entire property ecosystem is going digital. The DLD's REST app allows you to conduct almost any property-related transaction, from verifying ownership to paying fees, right from your phone. This level of digital transparency is world-class and reduces bureaucracy dramatically. A city's property market is only as strong as its economy, and Dubai's is built on diversification. Tourism, trade, logistics, finance, and now a major push into technology and green energy, all of these sectors fuel demand for housing. With world-class infrastructure, the world's busiest international airport, and a strategic location connecting Europe, Asia, and Africa, Dubai has cemented its role as a global hub. But let's look to the future. The government's Dubai Economic Agenda, D33, aims to double the size of the economy by 2033. The Dubai 2040 Urban Master Plan is a roadmap for sustainable urban development, focusing on green spaces, public transport, and quality of life. These aren't just buzzwords, they are concrete government strategies that will drive population growth. More expatriates, more tourists, more businesses, all needing a place to live. This continuous, planned demand is what underpins long-term, sustainable growth in property values and rental income. Now, while the Dubai market is exciting, it's not without its complexities. A smart investment requires smart due diligence. Here are the critical pitfalls to avoid. 1. Ignoring service charges. As we mentioned, high service charges can destroy your net yield. Before you buy, always ask for the building's service charge history. A beautiful apartment with a pool and gym is less attractive if the fees eat 30% of your rental income. 2. Choosing the wrong agent. Work only with RERA-certified brokers. Check their broker registration number on the DLD website. A good agent provides data-backed advice, not just a sales pitch. 3. Underestimating off-plan risks. While escrow accounts offer protection, delays can still happen. Research your developer thoroughly. What is their track record for delivering projects on time and to the promised quality? A top-tier developer might cost more, but it significantly de-risks your investment. 4. Forgetting closing costs. The purchase price is not the final price. Budget for an additional 7-8% for closing costs. This includes the 4% DLD transfer fee, agent commissions, and various administrative fees. Factoring this in from the start prevents any nasty surprises. Investors often ask, what about risks and how do I get my money out? Dubai has one of the most liquid property markets in the world. On any given day, hundreds of off-plan and ready properties are being bought and sold. Government measures, like the escrow laws we discussed, minimize the biggest risks of project delays or defaults. And the Dubai Land Department's clear, digital title deed system ensures your ownership rights are undisputed and legally protected. Your exit strategy depends on your goals. If you're looking for rental income, you can hold long-term. If your goal is capital appreciation, the active secondary market allows you to sell and realize your profits with ease. This combination of liquidity and security gives you flexibility. Let's look at two different investor journeys. Case Study 1, the yield-focused investor. Suppose you invested 1 million dirhams in a mid-range apartment in JVC 2 years ago. Rental yields averaged 8%, so you earned 80,000 dirhams annually, totaling 160,000 dirhams in rent. On top of that, property prices in the area rose by around 15%. Your asset is now worth 1,150,000 dirhams. Your total return is 160k dirhams in cash, plus 150k dirhams in equity, a total gain of 310,000 dirhams, or 31% in just 2 years. Case Study 2, the off-plan capital gains investor. Now consider an investor who bought a 2-bedroom townhouse off-plan in a new community like DAMAC Lagoons for 1.8 million dirhams 3 years ago, with a 50-50 payment plan. They paid 900,000 dirhams during construction. Today, as the project nears handover, similar units are selling for 2.5 million dirhams. They can sell their contract before paying the final 50% for a profit of 700,000 dirhams on their 900,000 dirhams investment. That's a staggering 77% return on capital invested without ever renting the property out. This strategy carries higher risk but offers explosive growth potential. Now for some advanced FAQs. 1. Is it better to buy luxury or affordable? It depends on your goal. Affordable often gives higher rental yields, 6-9%. Luxury offers stronger capital appreciation potential and attracts long-term, high-quality tenants. A balanced portfolio might have both. 2. Is off-plan safe? Yes, with top-tier developers and mandated escrow accounts, the financial risk is significantly reduced. The primary risk shifts from losing your money to potential handover delays. 3. Can foreigners get a mortgage? Absolutely. Banks in the UAE offer mortgages to non-residents, typically requiring a down payment of 20-25% plus associated fees. 4. What are the key legal differences between freehold and leasehold? Freehold means you own the property and the land it's on outright forever. Leasehold gives you the right to the property for a fixed term, typically 99 years. Most of Dubai's popular investment zones are freehold. So is Dubai property a smart investment in 2025? The data speaks for itself. It offers a rare, powerful combination: high rental yields, strong capital growth, zero property taxes, and a government that actively protects and encourages investors with a clear vision for the future. The market is dynamic, sophisticated, and filled with opportunity. Whether you're buying a luxury villa on the Palm, an affordable apartment in JVC, or an off-plan unit in Business Bay, you're not just buying property. You're securing a smart financial asset in one of the world's most exciting cities. If you're considering investing in Dubai real estate, the time to do your research is now. If you found this deep dive useful, hit that like button, subscribe for more data-driven insights, and drop your questions in the comments below. We read everyone and will cover them in upcoming videos. Thanks for watching, and we'll see you in the next one.